I'm joined by Jacqui. Jacqui, thanks very much for joining me. We're in two different parts of the country. I'm in Cork. I think you're in Kildare, somewhere up around that part of the world.
Yeah.
I really appreciate you joining me. We don't know each other, but we had a little bit of back and forth over the weekend on Instagram. And it wasn't so much your story that I was really impressed by or interested in. It's not impressed as the absolute wrong word, but I was interested in. And we don't need to go in through a whole pile of detail. And we definitely don't need to mention names, okay, of companies or anything else. But is it fair to say that you had a family member, you can tell us who the family member is if you want to or not, right? But you had a family member who lost a lot of money on pensions.
Yes,
Okay.
That's correct.
Tell us a little bit about it, and you don't have to go into a huge amount of detail. They're not here to give their own story. So your version of their story, what is it?
So basically, this particular family member, they had some shares that came to fruition, and so they got quite a large lump sum of money, which was great for them at the time. And they decided to put a good proportion of it into their pension pot. So roll on, not that many years after, to be honest, maybe 4 or 5 years after, everything basically went bang, and they lost the pot completely.
Okay, and it was a sizable amount of money.
Yes, it was an awful lot of money. I mean, something that you would, a lot of people would only, life-changing money, exactly. A lot of money that people would never see.
Okay.
It was a huge amount of money.
And as a percentage of their overall pension pot, was it all of it? Was it some of it? Was it...
This particular person had a couple of pension pots. They were quite savvy, to be fair, but this one was completely wiped out.
Okay. So completely wiped out, never to be recovered.
Yeah.
And they were invested in shares, or were they invested in some other type of scheme or something else?
I'm not actually 100% sure, because obviously I don't want to name any companies or anything here. So I'm not exactly sure what it was. Now, what I would say is this person was very astute financially, and so therefore they would have, chosen, I would have thought, a very decent portfolio, if you will. But clearly, if
it all got wiped out, if that particular part of that particular pension got wiped out completely, there was some decision that was made that exposed them to being wiped out completely. Okay.
Correct. Yeah.
Right. We got the background now, Jacqui, right? What I'm more interested in is you didn't go through that experience personally, you just witnessed it. So how has that impacted you? Have you steered away from pensions completely as a result, or where are you at?
So where I'm at is I do have a pension through work. I'm very lucky because work do an 8% contribution and we do 3%. So for me, it's, I have a very...
Becky, we can't just let that one go. That's incredibly strong. So if you put in 3%, they'll put in 8%.
Correct, yeah. So obviously... financially, it made absolute sense, tax-wise and everything, to just go ahead. Yeah. So I did. Now, obviously, there's always the talk of the AVCs, etc. And for me, honestly, I don't want to put any more of my own money in the pot because I am worried. I mean, if it, happened to my loved one, it could absolutely happen to me. Why wouldn't it, essentially? So I guess I am exploring other avenues, if you will, to try and secure, because I know I need a pension. I know that time will come and I'm going to need income. But I would like it in my head to feel a little bit more secure and more tangible. Maybe.
Okay, well, let's just kind of dissect that or break it apart a little bit. First of all, let's just credit to whoever your employer is. We don't need to know who it is, right? But credit to whoever your employer is, because effectively what's happened for you is you put in €3 into your pension, right? And you pay €1.20 less in tax. Okay, so it costs you €1.80 to get €3 into your pension, assuming you're on the higher rate, and I don't know if you are, but assuming you're on the higher rate, it's costing you €1.80 to get €3 into your pension. But it's not. It's actually €1.80. The tax man gives you €1.20, which brings it up to €3, and then your employer gives you €8. So you're actually €1.80 is turning into €11 for you, which is superb. And I can see why you didn't say no to that, regardless of your family members' experience and what they have been through. Okay. On the other side, however, you have got the opportunity to pay into AVCs, and you're not taking that opportunity because of what's happened with the family member. And I do think you're thinking to yourself, maybe I should do something else with the money that's a bit safer. And I know you didn't use that word. And what type of other things? Do you want to give me an idea of some of the ideas you're exploring on the other side?
Yeah, for sure. So I guess... we're definitely, I say we, myself and my husband, we're definitely considering buying another property for rental, because I guess in our heads we will have the capital of the property along then with the monthly rental income every month, and it feels safer because you have the capital, like you have the property at the end of it. And I know if you were to sell it, there'd be tax implications or whatever, but you can feel it, you can touch it, it's there, and it just feels, to me, maybe a more of a safer option than the money essentially going into ether, and you kind of don't really know what's happening.
Is it a safer, and you're right, like lots of people describe that, I can drive by the house, the 3-bedroom house around the corner, I can see what's going on to it, I can walk into it, and actually I'd bring it one step further. It's not just that you can touch it and you can see it, but you can also smell it. Like it's literally there, it's a physical thing. But actually I wonder, is the psychology of that more got to do with you understand it better? It makes more sense to you. Like, I buy that piece of brick and that lump of bricks. There's a couple of bedrooms in it. I throw a few people into it. They pay me rent every month. The second they don't pay me rent, I know there's a problem, and I go and fix the problem and I address it and I take all that hassle, right? But it is a kind of a psychological thing that because you can see it and touch it and feel it and smell it, that it's more understandable. Is that fair? That it's a more understanding thing and therefore you can do it that way?
100%. Absolutely. We already have a property, we own a property at the minute, and we see how what we bought it for versus what it's worth now. Obviously we're in the good times at the minute, it can all go completely wrong as well, but even just seeing the step down in the mortgage when we get our statements every year, you feel like you're getting somewhere with it, whereas I guess with the pension, you just can't see it. You just don't really know where it's at.
And I think if we break it really down, if you think about it, if you could think of a business in like any business, you know, right? And particularly if there was some family member, and I don't know anything about family members being in business, I'm not bringing you down the garden path here, right? But if you can think about it of a small company or even your favourite restaurant, right? If you look at your favourite restaurant, you walk into your favourite restaurant and you can see, oh, there's the chef and there's the front of house staff and there's the manager and there's the owner, right? And you can walk around that and you can see it. And then if your restaurant turned around to you and said, do you want to buy a tiny bit of us? If you give us some money, you'll participate in the profits of this restaurant. You'll participate, right? And you might say, oh, there's a bit of risk in that because it's one family or it's one manager and one owner and it could go wrong. Now, that's the start of the understanding of what you're doing when you're buying shares, right? Because what you're doing when you're buying shares is you're actually taking thousands of companies. You're buying a tiny bit of the biggest companies you could ever imagine in terms of GE and Tesla and Disney and Coca-Cola and everything else. It was a client, not a client, a buddy of mine who's also a financial planner told me a story about he was sitting with the CFO of a global company, right? And we won't identify them in any way, right? But a global company, sitting with them, he was doing his annual review with them and he goes, CFO goes, you know what? I'm just a little bit worried about where the markets are at right now. I'm a bit concerned about where they're going to end up, right? And I'm just not going to put any money into the market at the moment. I'm not going to buy any shares at the moment. And my buddy, who's a financial planner, turned around to him and says, well, hold on a second there, though. If the world goes wrong, are you guys prepared? Like, you're one of the biggest multinationals in the company, in the country, in the world, in fact. You're the CFO. Will you be, oh no, we'll be okay because we'll do this, right? And we'll actually get through if the world goes into a recession or whatever else. And my buddy turns around and goes, do you not think there's a CFO in all of the other 5,000 biggest companies in the world who have exactly a similar plan and they'll get through it in the end, right? And my point about this is I'm not trying to convince you. What I'm trying to portray is when we understand things a little bit better, sometimes it's massive and it's big and it's 5,000 companies. But when we bring it down to, if I owned a little bit of the restaurant, what would my problems be with it? But my problems would be it's a bit minute and there's too many personalities involved. As the company gets bigger, there's more strategy and process and procedures and policies and everything else. And then you multiply it out. It's just not one company you're going into, it's 5,000 companies you're going into. So even if you just start to get your head around, it's just about understanding it. Companies are always going to go through bad times and good times. And it's about just trying to keep going with them so that you say, I know statistically, if I take my money and put it into a 60-40 portfolio and I leave it there for 5 years of my pension, I have a 99.6% chance of a positive return. Full stop. Right? If I leave it there for 7 years or more, there's no chance of, there's been no 7 or more year period in the past where I would have lost money. Okay? So what I'm saying is I totally accept that you're carrying some burden around pensions in your head around, I watched the pain that person went through. I absolutely recognise and I don't want to feel that pain. There's a little bit of an element of you're cutting your nose off to spite your face. And let me tell you why, right? Even if you said, like when you break down what the situation with that family member was, the pension wasn't the problem. It was what the pension invested in was the problem. Do you agree with that?
No, I do, because the particular person had other pensions, and so at retirement age, was fine. It wasn't like they had absolutely nothing because they were clever enough, I guess, to maybe be diverse with the different companies or whatever that they chose to have pensions.
Yes, and what I would say here is when you separate the two things between pension and the pension, what it's invested in, and then you say, okay, so it wasn't the pension structure, it was the underlying investment that caused the issue here. Then you can start opening your mind to put money into pension, because we looked at, you're turning 180 into €11. If you put money into AVCs, it costs you €6 to put €10 in. Okay, because the taxman will pay for it. And you're walking away from that. So what you're trying to do is you're trying to, instead of using your before tax income to buy a property, for example, you're using your after tax income. So you're already if you're on the higher rate of tax, you're already been hit with 50%, right? Roughly, okay? So you have to make 200 quid to have 100 quid to put into the deposit for the house, okay? So if you put that money into pension, and the rules have changed for pensions a couple of years, but I don't know if anyone's ever sat down, and I don't know, you've mentioned your partner, right? I don't know if what type of setup he's in, but for most people, but some people are excluded, but for a lot of people, you could actually take money, stick it into the pension, get tax relief on it, go buy a property, never pay capital gains tax on it when you sell it because the pension owns it and it's tax free. And the rental income, you wouldn't have to pay tax on it either because it's going into the pension. Okay? Now, I'm not saying I'm a fan of that. I'm saying, like, that's not for everyone. I'm far from it. But if you're dead set on going buying property, you should be investigating, looking at that and saying, okay, if I'm going to buy a property, why not buy it with my before tax income using my pension instead of my after tax income using my savings? It's still a property. I can still touch it and see it and smell it. There are rules around what properties you can buy. There are rules around your connection with it. But the point here is that what's happened for you is you've got burnt by someone else's experience and you're applying it across the board and you're making your financial life much harder on yourself. Does that make sense, Jacqui? Because I'm rabbiting on here and I'm really conscious. But what I would say is the message I'm hoping you're getting from this is this is not about the pension being the problem. This is about the way the pension was invested was the problem. I'm not saying the family member made that decision by themselves. I'm saying I would strongly suggest they were advised to put the money into whatever it went into. I'd strongly suggest that's what happened. And they took that advice. And where pensions go really, really wrong is when somebody buys bank shares in 2007 and the bank disappears, right? Or somebody buys into some type of project that just falls apart, or the pension goes into something where fraudulent behaviour happens and there's court cases and everything else that come out of the back of it, right? So it's not usually every time I look at pension problems, it's not the pension, it's the investment it went into. And that's why we are really simple and really boring when it comes to putting your money away, whether it's pensions or investments. And Jacqui, what I would say to you is you have, I don't know what age you are, I can guess you have quite a number of years to go to retirement, and you can make your financial life easy by doing it all from your before tax income, getting the advice you need to get from someone who's really comfortable about giving it to you, or you can make your life twice as hard because you have to pay 50% tax to be left with the 50% afterwards. Twice as hard for yourself financially, and it's going to be a rougher road and it's going to be harder to get there. Yeah. Tell me what you're thinking when I'm saying all of this.
You know what, I find it really interesting actually when you explain about the shares, that it's, you know, lots and lots of companies and you're taking a little small bite. It has never been explained to me like that before, and it makes it feel actually a lot clearer, but also somewhat, in some sense, a bit safer, because it is a diverse amount. You know, it's not just all of your eggs, if you will, in one basket, which I feel happened to my family member. So it does definitely feel a little bit more secure.
Like, there is zero doubt. There is zero doubt that if you compare property to shares, right? Buying a 3-bedroom or 4-bedroom property, like, all it takes is some social behaviours in the house next door or some other problems, and that property is devalued, right? And I'm trying to be very generic here, right? That property is completely devalued. You can't get it rented out, or all it takes is a recession for a period or an oversupply of rental. I know that seems completely reverse from us, but we're talking about you buying a property now and having it all the way through your retirement. It's a long period of time, and we'll go through different cycles. And all of those things, when it's one property, like one, you're now sitting going, that's a lot of risk. All it needs is a bad neighbour and I'm snookered and I've devalued my property. Yeah. All I need, and I know it's long gone by, but it's not actually long. I was about to say, like, what's the asbestos? Or all it needs is like a mica situation. Like, those people in Donegal in particular, and I know it's other places in the country, they're going through hell at the moment. And if that was their pension, they'd be saying, I wish I had to put it into shares. Yeah. And when you all of a sudden then start going, okay, so I'm not going to invest in one company share, I'm not going to invest in 5, I'm going to invest in 5,000 or 10,000. All of a sudden you have completely spread your risk out, and it's significantly less risk. But not only that, I have clients who come to me in their late 50s in particular, who would often come to me and say, Eoin, it's not that I want to know, is it the right thing to do to keep they already have property, let's say. I don't want to know if it's the right thing to do financially to keep the property. I just want rid of it. I'm fed up with it. I just want it gone. I'm fed up with the phone calls to replace the fridge, and I'm fed up with, I want my life to be easier in later life. So is there anything else I could do with this money? I just want to make sure I can live my life the way I want to live it. And if I'm going to be worse off financially a little bit, as long as I can live my life the way I want to live it, I don't really care if it's going to be something coming off the bottom line at the end of it. So just be careful about the route you're going. That's all I'm saying. It is, if you dilute the risk dramatically, you're taking significantly less risk than any individual share, property, scheme, anything else, right? If you have a tiny bit of all the best businesses in the world, I'm not sure you can dilute your risk any further.
Yeah, no, it does make sense.
Can I ask you, Jacqui, right? I'm not expecting that I'll have changed your mind, but have I opened your mind to the idea of looking at alternatives?
Yeah, I think so, definitely. I think, do you know what? There's probably a piece for me on the advice, of going to someone to get the solid advice on the options that are out there. I think I've not done that, bar through my employer, and like that, we're just all kind of in a fund together. Yeah. We can't flex it, but I've just said, pop me in whatever is the standard. But I guess it's probably to gain the advice, because even what you said, I mean, I didn't know that. I just turned my nose up to the whole, point of it and thought, oh God, I don't want to risk my own money.
And so, that's why when we were talking back and forth at the weekend and you said, oh no, I haven't lost faith in pensions. I put my 3% in, but I wouldn't put into AVCs. That's why I wanted to talk to you to see, can I actually do any convincing here? And I'm comfortable enough we got somewhere. We're not over the line maybe just yet, but I think we've got somewhere with you.
No, and definitely for me, I think it's to gain the advice. Like, it's, it's not my forte, it's not what I do. Yeah. So I probably just need to get a professional to tell me
this is how to do it
and explain it, but that's super helpful.
Yeah. Jacqui, thank you very much for your time. I really appreciate you taking the time out. I know it's time out of your day, but I appreciate it, and I'm no doubt the listeners will too.
Thanks so much, Eoin.